Guys, I'm closing in on 40 years old. And if I knew now what I know about personal finance and wealth building, I can clearly see some mistakes that if I had my time over, I just wouldn't make again. So guys, stick around. I'm going to walk you through some of the most important financial things that I would change if I had my time again. And on top of that, I'll also step through some of the things I'm doing now heading into my 40s, which I'm using to try and correct those mistakes. It's not really about regrets of mine or anything. It's more just a reflection on things that could be done differently. And hopefully that'll help someone who is still in their 20s or early 30s to try and correct those before getting to the point I'm at. Mistake number one, not starting early. Now the best way to illustrate this is we run through a simple example. Let's say that you graduate from university or graduate from school and you have fun for a few years and muck around and do whatever you want to do. But at the age of 21, you get yourself a stable job paying a full-time permanent income of $800 in the hand a week. Now, you're going to take just 5% of that income, which equates to $40 per week. And for simplicity, let's assume that you never change jobs and never get a pay rise. Now, if we invest that $40 per week at an average return of 10%, and we continue the same investment into the same investment fund, at the age of 50, those small amounts invested every week will be in the area of $350,000. Now, there's a lot of 50-year-olds that probably don't have $350,000 cash to their name. Now think about the same example if you're factoring in pay rises or tweaks to your investment where you're adding a small percentage, 1 or 2% every 6 months or every year, you're tweaking that where you have the ability to. It can significantly change the landscape of this scenario over time. The biggest traps and things that you can tell yourself, and ones that I absolutely fell into here, were telling yourself that you'll do those things later, and you'll find another reason to spend your money, or you're not informed enough yet, or it's not going to make an impact or move the needle enough. For me, if something didn't make an impact right away or wasn't going to make a significant change to the bank balance, I dismissed it as just not worth it or a waste of time. I wanted fast results and overnight wins. Crypto schemes, trading strategies, or just trying to chase the next 100x investment that was going to change my life overnight. These all formed a large part of the mindset I had when I was in my 20s. Looking back now, that need that I had for instant gratification was one of the most expensive mistakes that I've made. Guys, if there's one takeaway in all of this, it's to start early, start small, and stay consistent. Mistake number two, trying to time the market. Now, guys, this is an important one that I believe almost everyone struggles with. And largely it's due to a lot of the noise that's out there now, with all the platforms available and all the information where everyone has an opinion. Some people are going to say we're at the top, others are saying, we're only just at the bottom, we're going right up, and then others will tell you we're about to crash. So everyone has an opinion. And the best thing you can do is honestly to shut out that noise and find the investments that you firmly believe in. To help me overcome these things, I've really had to embrace things like automated investing, so dollar cost averaging, ensuring that you're not letting your emotions dictate whether or not you make that investment each month or week, however often you have it set up for yourself. Now guys, it's not to say that you can't buy at better times. Of course you can, but what I found for myself that helps to eliminate a lot of the mental energy, stress and anxiety that comes from these investments is picking ones that you believe in and then either automating the process if it's available on the platform that you're using, or if it's not, then picking a certain day and time and having that locked in to make the investment. The more that you watch the charts and check for the small price movements, the more mental energy you're expending on this. Your investment time horizon, for the most part, shouldn't be measured in days, weeks, or even months. It should be measured in years. Mistake number three, ignoring superannuation and retirement planning. Now guys, this one's a boring one, and it's exactly why it often gets overlooked. So you're 18 years old, you join the workforce and you sign up to whatever superannuation fund that your employer has on offer. And the problem is that's normally it. You don't really think about your superannuation fund until all of a sudden you're past 30 years old and time's moving faster and faster, and you think to yourself, oh, well, I better start worrying about my superannuation. You know, where is it at? You start to take an interest in it. It's a really common path, and to be honest, it was mine too. Up until a number of years ago, it wasn't even on the radar for me. Now, superannuation, no matter how boring it seems, it plays a vital and large part of your retirement planning. And for many people, it doesn't have to be your only part of retirement, and it shouldn't be, but it's an important part and it needs to be treated as such. Now, what does making sure you're aware of your super and what does all this actually mean? Well, there's a few things you can do. First is obviously choosing a fund that you trust and that you've researched and you're happy to have your money invested in. Number two is to ensure that you've got access to that superannuation fund, whether it be through a phone app or their web portal. Number three, checking the investment allocation is suitable for what you want. So if you're in your early 20s, you know, often I'd say it's suitable to have something that's more on the higher risk, higher growth. And as you get older, obviously the super funds generally will sort of scale that back. And then four, and importantly, making sure that you're aware and that you've double and triple checked what insurances you're paying out of your superannuation and whether they're, you know, suitable for your situation. Now guys, these are really simple things, but over decades, as the contributions get larger and the growth continues to compound, just like in that first scenario I gave you, they make a huge difference. Guys, none of the mistakes that I've talked about have been overly drastic or life-changing or altering at the time. But that's exactly why they get overlooked, or exactly why it's important to be aware of them. Because when you're young, you're living for the now and you're not thinking of future you. Looking back on it, I genuinely can say that I wish that these things were explained to me at an earlier age. And if me sharing my thoughts on it even helps just one person to start small and start early and drastically changes life for not just them, but potentially even their future family, then it's certainly done its job.